Hello everyone out there in tax land, Dan the tax man here, tax professional with Community Tax, and today I want to talk about the tax consequences of Bitcoin. Now, Bitcoin is getting a lot of exposure in the media right now because it's currently trading at all-time high rates, somewhere in the area of about $19,000 US per Bitcoin. So I wanted to take a few moments to chat about the tax consequences of buying, selling, and owning Bitcoin. So what is Bitcoin? Well, I'm happy you asked. Bitcoin is a digital currency, also sometimes referred to as a virtual currency or cryptocurrency. A Bitcoin itself is nothing physical. It's 100% digital. And if you had to distill it down, all it really is a string of numbers. And it can be stored in a computer file, on your computer, on your mobile phone, on a zip drive, wherever. What's really revolutionary about the Bitcoin system and why it works is that ownership of Bitcoin is stored on something called the blockchain. The blockchain is a public database that's decentralized, stored across thousands of different computers. And this is critically important because it's stored on so many different places. If one person is to try and unilaterally change any of the numbers in the Bitcoin blockchain, the rest of the computers would recognize that there's something wrong with that. They would see that it does not match the rest of the blockchain, and they would reject the transaction. And in this way, you can maintain the integrity of ownership of Bitcoin. Where do Bitcoins come from? Bitcoins come from a process called mining, which is basically a very powerful computer that is set to solve very complex Bitcoin math equations. When that Bitcoin math equation is solved, the owner of the computer that solved it is awarded with a few Bitcoins. Now, as more and more Bitcoins are introduced into the market, these equations become more and more complex, much harder to solve, and that's what prevents the market from being flooded with new Bitcoins. It controls the rate at which the Bitcoins come into the market. And before you go out and buy your own computer to start mining Bitcoin, just keep in mind that at this point in the game, the equations are so complex. If you started today, it would probably take several years before you earned your first Bitcoin. And with the cost of the computer, the energy, the electricity it takes to run that computer, and the volatility of the market, you never really know if it's going to be worth your while. But right now, there are computers dedicated to solving these equations, mining Bitcoins, and earning them for their owner. The other really revolutionary part about Bitcoin is what happens when you try to exchange it, whether it's for other cash or for property or services. When you exchange a Bitcoin, that transaction between the buyer and seller is recorded on the blockchain, on that public database, but the parties to the transaction remain 100% anonymous. They're just recorded as a string of numbers. And there's no third party to that transaction. Presently, every digital transaction you make, whether it's a credit card at a store, or buying something on the internet, there's always a third party. There's a bank or some other clearinghouse that's monitoring and keeping track of that transaction. With Bitcoin, there's only two parties, the buyer and seller. There's no third party. You have all the benefits of a digital currency. It's flexible, it's fast, it's modern, it's convenient, and you have the anonymity of cash. Digital currency with all the benefits of digital and the anonymity of cash. That's what makes Bitcoin truly unique and truly interesting. Now, because Bitcoin is so new, because it's anonymous, because there's very few large third-party clearinghouses overseeing these transactions, it's basically impossible for the IRS to monitor them right now. But I suspect that as Bitcoin gains popularity, as it gains legitimacy, the IRS is going to increase its sophistication and its enforcement in this area. And at some point, it's going to want to make an example out of someone who's not recording their Bitcoin transactions correctly. And you definitely don't want to be that person. Now, the IRS made a formal position in IRS Notice 2014-21 that Bitcoins for tax purposes are considered property. That means the implications for buying and selling Bitcoin are very similar to the tax implications of buying and selling stock. Notably, when you purchase a Bitcoin, vitally important to keep track of your purchase date and purchase price. That purchase price becomes something we call your cost basis. There's no tax consequence for owning Bitcoin, even if the price goes up and down. You only have a tax consequence when you sell the Bitcoin. When you sell the Bitcoin, you take your sales price, you subtract out your cost basis, and you only pay tax on the gain. Now, if you've held that Bitcoin for less than a year, you pay short-term capital gains rates, which are the same as your ordinary tax rates and currently top out at 37%. If you've held the Bitcoin for longer than a year before you sell it, you get to pay long-term capital gains rates, which currently top out at 20%. So it's vitally important if you're an investor and can help it in any way to keep your capital asset, the Bitcoin, longer than a year before you sell it, then you're going to pay a lower tax rate. Also, vitally important, especially right now, that you're keeping detailed records about the purchase date and purchase price of any Bitcoin. Because there's very rarely a big third party that's monitoring the data points in the transactions, like the purchase price, purchase date, because it can be peer-to-peer, where it's just the buyer and seller involved, there might not be anyone else keeping track of that purchase price and purchase date. So vitally important for you as the taxpayer, as the investor, to keep those records. Number one, so that you can report it correctly on your tax return. And number two, if you ever get audited, the IRS is going to want proof of the purchase date and purchase price of that Bitcoin. If you can't supply the proof, there's a chance they won't give you credit for that basis. You're going to pay tax on the entire sale price, and you're going to end up paying way more tax than you should have. Now, if you are mining Bitcoin, or if you are receiving Bitcoin as compensation for services, then you need to include the fair market value of that Bitcoin on the date that you received it in your ordinary income. So Bitcoin is currently worth about $19,000 per coin US. If I receive a Bitcoin as compensation for doing this video, I need to include as income on my tax return $19,000, reflecting the value of that Bitcoin on the day that I received it as compensation. And if I'm an independent contractor, which is the most likely scenario if I'm working for Bitcoin, then I would need to include that $19,000 on my Schedule C, and I would need to pay self-employment tax in addition to paying income tax. But it's not all bad. If I were later to sell that Bitcoin, I would get to subtract out as a cost basis the amount that I've already included in income. So if I've already paid tax on $19,000 and I sell it for $29,000 in 2 years, I would only pay tax on the difference, or $10,000, not the full $29,000. So there you have it, a highly informative video on the origins and tax treatment of Bitcoin. Now, if you have your own tax issues or would like to discuss tax questions with a tax expert, call me and my team at Community Tax at 800-424-8332. And if you're a Spanish speaker, feel free to call us at 888-523-6606. If you've enjoyed this video and would like to stay up to date on all the latest tax tips and insider knowledge, give us a like, give us subscribe. I am Dan, the Tax Man, tax professional with Community Tax, and I will see you next time.